Welcome to Money Control. Well, the market is trading slightly higher this morning, but it has been steadily climbing up after the slide in the middle of last month. Budget is done and dusted. That was one big event. What will drive markets from here on? How do you position yourself? What should you be watchful of in this kind of market? Well, I have a very astute fund manager, Hiren Ved of Alchemy Capital. Hiren, thank you so much for joining me this morning.
Thanks, Mahalakshmi. It's a pleasure to be here.
So first things first, Paytm up about 10% this morning. What's your take?
Look, I think, what they've built is truly fantastic, right? 4 crore customers. They became very famous during demonetization because everybody had to download the app.
Correct.
The consumers went onto the app. The merchants went onto the app, and then it became the de facto sort of platform for payments. And while everybody in the private sector thought UPI mein paisa nahi hai, they obviously had a very good market share they built.
Correct.
So it's like, you built a road where you can't collect toll. So you run on the road, but you don't get paid for it. And then slowly they started to monetize the traffic that was coming onto their highway through the wallet business, then now through the lending, largely through the lending business. And they also make some money on MDR from merchants, right? And I think it was unique. Paytm was unique in the sense that they not only had the platform to consumer, but they also had the platform to business.
Right.
And then they could cross-sell across the two.
Right.
So I think they had built a very good platform, but I guess that the RBI wanted the Paytm Payments Bank to be at arm's length with Paytm, the service provider or the platform. And I think that's what has created some of these regulatory issues, right? And investors don't like uncertainty, right? And I think that's why you saw the reaction to the stock price. Have they built something of value? For sure. And they were also on the path to profitability. So I think they laid out that they were, steadily moving towards that, and the investors got a lot of confidence that, we're going to turn profitable. But now with something like this, you don't know. I mean, they've obviously quantified the impact, but sometimes, you don't know how long it takes for you to claw back what you've lost. And I think, therefore, for some time, maybe the stock remains around here until there's further clarity on how they deal with this issue.
So you're saying, so what is the real impact? What they have said is 300 to 500 crores of EBITDA impact. That is pretty much the worst that can happen in terms of what the financials look like today, because that is assuming like your entire wallet business goes away.
Yeah.
Is there anything else that you would be worried about? I mean, suppose we were to just, bifurcate this whole problem into the uncertainty problem, which of course will prevail, and we don't know anything about it, and the fundamental case for Paytm. What would that look like? Because today it is up 10%, so maybe around 30,000 crores or something, maybe the market cap. They have about 8,000 crores in the book. So 21,000 crore must be the value of Paytm.
Yes.
So at that market cap, what do you get to really buy?
Well, you get 4 crore customers transacting on their platform, and also the fact that you can therefore use and mine a lot of the data, and to a section of those customers you can give small ticket loans, right? BNPL loans, whether it is to the consumer, or you could also do working capital loans to the merchants. And I think that's a profitable business that they can build around that, right?
My and only 40 million customers is largely merchants, right?
Well, it's consumers. 10 million are merchants, right? And they have seeded a lot of sound boxes and stuff like that with the merchants. Now, I think there are a couple of complications, right? Like, for example, because the wallet goes away and a lot of your other utilities were tied to the wallet.
Yes.
What happens now? Are they able to smoothly transition from the Paytm Payments Bank to another bank, right? All of this will have to be seen. So one is that, okay, there's a 300-500 crore impact. Now that can be priced in pretty quickly, right? The markets are very quick to price something like it very quickly.
Correct.
The question is, are there further roadblocks? How long does it take for me as a user to use Paytm as seamlessly as I was using earlier without any disruption? I don't think we have all the answers, but I think as time goes by, we will have some of the answers.
Would it be an interesting strategic buy for anybody, because so many banks, newer banks in the fray, there are every traditional bank today wants a piece of the pie, right? Like action in the digital space. Would it be of interest to anybody? Could there be strategic value unlocking in Paytm?
I mean, you can't say no. There could be. Now, I don't know whether Vijay is willing to sell.
Right.
And, you know, there may be buyers, whether the existing founders are willing to sell and at what price, right? And then something which is so regulated, whether an M&A or a strategic deal is blessed by the regulator or not, is also another dimension that we have to look at, right?
Sure.
I mean, one bank taking a stake in another bank, you know how complicated these things are, right? I mean, RBI wants all financial intermediaries to not be dominated by a single founder. You can't have a CEO remaining as a CEO for a long period of time. They want rotation.
Correct.
So I think how the regulator or the RBI thinks about this is also equally important, and we don't know, what that thought process is today.
So a lot of fintech founders have now, written to the finance minister, PM, RBI, etc. So does this spell bad news for this industry as a whole, the way it operates, or is this just a Paytm problem?
I hope not.
And even in the financial space, this is not the first time that, of course, something severe like this has happened for the first time. But, RBI has put restrictions on Bajaj Finance, on HDFC Bank. So there have been several cases in the past 2 years itself.
Yeah.
So is the regulatory environment becoming really stringent? Will that sort of have an impact on financials in general?
So, I mean, I think we are seeing that the RBI is tightening it's the inspection of the regulatory environment, whether it's the fintechs or the banks. I kind of, if I were to draw a parallel, to me it looks like that this is the US FDA moment for the financial services industry.
Okay,
right?
so that means prolonged period of pain.
Yeah, we don't know. I hope not. Hope not. But it looks like for now, right? Because when the first time it happened, people thought, oh, it's just one company specific, one plant.
Right.
And then the incidences of this kept on piling up. And then eventually the industry had to really deal with this huge US FDA problem. And all of them had to take remedial measures. And, some people were let off light, some people had import alerts, and that really impacted the business longer term.
Correct.
And I think the sector as a whole underperformed.
Right.
Now, I am not saying that the same thing is going to happen here, but we got to watch this space very carefully.
Right.
That if there are a lot of regulatory interventions, they may all be justified from the regulator's point of view, but then the confidence of the players, the confidence of the investors, people do take a step back and say, hey, let me see what's happening here.
Right.
And so it's critical.
Right.
How things unfold over the next couple of months.
So is there any section of the financial space, because financials is the largest weight in the index also, right? I mean, I'm sure for you it's not as important as for the mutual fund managers or even the individual investors, but still it's 40% weight in the index.
No longer now, it's come down to 35.
35, right? fair enough, 35. So 35 is also large enough, right? It's a big number.
Yeah.
So any sections that you are, I mean, how do you play the space? Because one narrative market narrative is that if India were to grow, how can you not have, a piece of the banking action?
Yeah, you see, I mean, everybody tries to justify an investment in the banks and the financial services by saying that if India has to grow, if India's economy has to be 7 trillion or 10 trillion, then don't you think, obviously they will grow, right? I think there are a couple of things at play, right? And this could be more a medium term kind of a situation. So if you look back at the previous cycle, right, if you look at the go-go years of 2003 to 2008, 9, 10, right, when there was a capex boom, when there was a power boom, when there was an infra boom, and all the banks had lent to infrastructure projects, including the PSU banks and the private banks. And then they all got hurt, right, because of the coal scam and the telecom scam and the 2G scam and all of that. And that entire sector came crashing down. And they were all hobbled up with huge NPLs. And obviously when you have that kind of a impact on your balance sheets, on your NPLs, right, the behavior changes.
Correct.
And then everybody had to raise capital, they had to provide, they had to clean up the balance sheets. And then everybody said, you know what, we are not going to lend to the infra sector.
Right.
We are going to do granular loans to the consumer business. Everybody wanted to do mortgages.
Absolutely.
Everybody wanted to do personal loans. Everybody wanted to do consumer durable loans. And therefore, the entire private sector banking industry went headlong and became consumer banks.
Right.
Now,
but that is also because growth was only in that segment. Like for a large part of last decade.
I agree, right? And I'm coming to that. And now, if we see where we are today, if you look at the data in the last few years post-COVID, right, we've seen that unsecured loans were growing very fast.
Correct.
And I think somewhere the RBI took note of it and they realized that they need to take a proactive stance and kind of slow down, and therefore they increase the risk weights, right? Because they don't want any particular section growing much faster than, significantly faster than the average, right? So now, if you look at the banks, obviously if you do unsecured personal lending, your yields are the highest there. So your profitability is the highest, right? On the other hand, we have a situation where currently the liquidity is tight, right? There is no surplus, there is deficit liquidity. So raising deposits has become a big challenge. So on one hand, your cost of money, your cost of deposits is going up. On the other hand, your risk weights on your fastest growing, most profitable part of the business on the asset side is being slowed down, right? So you got a double whammy on both sides, right? The third thing, which is a much more technical thing, is that this is a space which is over-owned, right? So all the mutual funds, all the portfolio managers, everybody loved the banks because they were the leaders of the previous bull cycle and they did so well and the growth was so fantastic. So everybody has allocated to that area.
Right.
And now you have headwinds, right? Maybe they are temporary headwinds, but there are headwinds. And the space is over-owned, right? And therefore, we've seen that in general, this entire consumer lending space has underperformed, right? Especially the private banks. Now, the action has shifted to the public sector banks because, markets have cycles, value has done in general better, and you've seen a big rating. But I think, I am of the firm belief in market cycles that, as they say, naye race ka naya ghoda, right? A new bull market has new leaders.
Right.
Now you see what's doing well, right? I mean, it's the infrastructure funders or the NBFCs, the REC, the PFCs, the HUDCOs of the world, which are doing far better than an HDFC bank or whatever, right? So leadership changes, and it's always very difficult at these turning points to justify to yourself. And people have been racking their brains over over and over again to say what's wrong with an HDFC bank, what's wrong with an ICICI bank. But unfortunately, markets have their own ways, right? So I think if you have if you're a value investor, you have a very long-term view, these are great franchises to own. Whether they will outperform the market, I do not know. It doesn't seem like in this cycle. I think the very clear writing on the wall is that the public sector banks and the infrastructure financiers are the ones which are actually doing well in the sector. But more importantly, I think, as somebody said, we are moving from, Indians are moving from being a country of savers to a country of investors.
Right.
So I think there is more money, in my view, to be made. If you don't want to get down to the PSU bank route or the infrastructure finances, then I think the one way to play that is to play the capital marketplace, right? The asset managers, the wealth managers, the CDSLs, the online brokers, because obviously we've seen that more and more people are doing SIPs, they're investing in the equity markets. And I can use the same argument. If India's market cap is going to be 7 trillion or 10 trillion, and then eventually if India's market cap is also going to be 7 and 10 trillion at 1 times GDP, then why can't these companies also grow?
Right. Sure. So one question on banks, and then I'll take one more question on AMCs. So the question on banks is, you're saying that, the infrastructure lending companies, REC, PFCs of the world, Tourism Finance Corporation, HUDCO, whatever, all of these, this is the set of companies that's doing well apart from the larger public sector names. Now, most people who make a case for private sector banks, or any bank for that matter, even the public sector banks today, they look at historical valuations and say, this is where it was, this is where this is such a huge gap. For example, HDFC Bank, anybody talks about today will say, today it's trading at 2 times book. Whenever was it in the last 20 years that it was at 2 times book? So do we always benchmark, and these, at least for the last 10-15 years, these were the banks, these quality banks really set the valuation cap for the banking sector. So everything is like at a discount to those banks.
Yeah, so they became
now,
the reference point.
Reference point.
Yeah.
So now that reference is shifted.
Yeah.
What does this mean in terms of where public sector valuations can go? Because it is easy, like you say, to make a case today that growth is here, and therefore these banks or these, the public sector and the other, state-owned banks will grow.
Yeah.
But how do we evaluate what kind of headroom do we have there, considering that the reference has shifted?
Look, it's, what I think and you think where the valuations could settle, I think it's very difficult to predict that. It's the collective wisdom of the market that will decide, right? So there was a point in time when HDFC Bank was the most premium bank.
Correct.
To trade at 4.5 times price to
Correct.
book. Until a Bajaj Finance came.
And traded at 9 times book.
And traded at 8 times book.
Right.
Right? So if we were to just look purely at history and say, if HDFC is at 4.5, so Bajaj at 4.5, or a discount to HDFC Bank because it's an NBFC, it's not a deposit taking bank, well, we would have missed the entire rally from, whatever, 2-3 times book to 7-8 times book, right? So we don't know whether these PSU banks can trade. Historically, they have traded at 1.2, max 1.3, and that's the end of the story, right? So because we always have these previous benchmarks, but I don't know, and neither do I want to take that call, right? I think the markets will decide that call, whether they want to trade them. And I think we all get muddled up between, ye PSU hai, ye private hai. I think what's important is the context, right? Even if you take a private sector bank, let's say, which is not very well run, and then you have a change in management, and then they set a lot of things right, and then the bank is run very well, then there is a case for re-rating, right? just because we wear the PSU hat, and I understand, including myself, we all have our hindsight biases, right? And that is what is troubling a lot of people, that they are not able to justify or go beyond saying, okay, the last 10-year average valuation was this, and therefore the private sector banks are looking cheaper, but they continue to trade cheaper. And the public sector banks continue to re-rate, right? And I think the context has changed because this government and this regulator is very clear. They don't want any funny stuff happening in the public sector banks. They're trying to improve the governance structure. They are trying to improve that they don't do the same mistakes they did in the previous cycle. There is a lot of oversight. The banks themselves have learned. I was yesterday meeting the SBI chairman, right? And his first thing about, giving a vision was that, look, we've invested a lot in our risk management. We know how to underwrite. We've created a lot of domain knowledge in various sectors. We will do this, we will not do that. The language is very different. The language is not, I want to grow at 20%. Right? The language has changed. So if the governance changes, if the quality of management changes, then there is a case for re-rating. Why should I cap it at 1.2 times? And why not higher? But anyway, as I said, it's not me. It's the collective wisdom of the market that will decide what valuations these stocks can trade at.
But are you bullish?
I am.
Okay.
I am, in the sense that, we have played this partly through other capital market intermediaries, and we have reduced our exposure, and we are so-called underweight the financials, if the traditional lenders, so to speak, right? Because I genuinely do believe that the markets can't be wrong for so many quarters. I mean, ICICI Bank gives you picture perfect quarter after quarter numbers, right? And the stock doesn't move.
Yeah. So, okay. And on the capital market place, right, there is always this, with markets also, there is a certain sense of disbelief that, markets just scaling new highs, and you see just 7-10% correction, and then there is this pullback.
We've not even had a 7-10% correction on the Nifty.
Right. So when you evaluate these capital market, the niggling doubt is always that, there might be asset erosion, whether it is broking business or the asset management. Directly, you will see that impact in the bottom line. So how do you evaluate or consider that risk, considering that today, whatever you see, even whether you see Nippon Life or any of the asset management, HDFC is at a different plane altogether. So many of them are still don't look like, it's what we would have thought was reasonable valuation. So how do you size up that opportunity in terms of valuation? Is this a good entry point? Do you have to wait, watch?
So I won't comment on specific companies, but I think asset managers, wealth managers, exchanges, online broking platforms, market infrastructure intermediaries, they all benefit from greater and greater participation of domestic money flowing to capital markets, right? And it's a structural story. Just like you can argue lending is a structural story, I think savings going into equity markets or to financial assets is a structural story. Right? Whether to debt markets or to equity markets or whatever. And I think that people are still underinvested in that, right? So, you could argue, I mean, like the best argument is, okay, if the nominal GDP grows at 10.5-11%, credit growth will grow at 12-13%, some of these private banks will grow at 14-15%. If the Nifty compounds at 15%, then at least the asset managers will compound at 15%, the wealth managers will compound at 15% or more, right? So that's the base level. So I think you have similar growth opportunity, but you don't have to worry about the balance sheet. You don't have to worry about interest rates. You don't have to worry about any of those issues, right?
Right.
So I think it's a cleaner play, and people can decide where they want to play, whether it's through an asset manager or a wealth manager or an intermediary or an exchange.
Fair enough. Okay. So what were your takeaways from the budget? Because, there is a mixed feeling about this 12% growth in capex. Do you see that becoming a bigger number in the, in the budgets that will come after, if this administration comes to power, will that become a bigger number? And of course, a lot of this growth has already been priced in. What's your take on that? And that is one of the reasons we saw why many of these stocks really did not move on that day, because
we have this old habit that before the budget everybody buys railway stocks and defense stocks, and then they want to look at the number that comes in the budget and then whether it goes up or go down. Those are very short-term moves, right? First of all, if you look at the revised estimates of capex, it's not a 11% growth, but it is more like a 14-15% growth, because you didn't spend everything that was budgeted for. So budgeted number to budgeted number could be 11,
otherwise 14, I think.
But it's actually more like 14%, right? And it's not small by any stretch of imagination. Having said that, people forget that while this is an important number and a broad indicator, it's not, the capex doesn't happen only from the central balance sheet. There is the state level capex that happens. Nobody's talked about that. Secondly, PSUs
I think
also do
in the last 5 years, this is the first year that you have seen a positive change in PSU capex.
Yes. Then now the government is encouraging all the PSUs to also invest. So the thermal guys are doing renewable capex, everybody is doing, Coal India is spending on increasing output. Every PSU is doing capex. Now we are not counting that, right? So the government drives capex through several balance sheets. Its own balance sheet, it encourages the states to spend, they encourage the PSUs to spend, and the last, also they direct lending which is done by these infrastructure NBFCs, who also enable capex to happen, because if an REC is giving a loan, or a HUDCO is giving a loan, or a PFC is giving a loan, it's funding a project, right? So it's 4 balance sheets and not one, and everybody is focused on just that one number. That's point number one. B, I think that by now everybody should be clear that this government is very clear that they want to spend on infrastructure, and all their reforms are supply side. They don't want to stimulate demand by giving giveaways or give money away to people, and thereby creating a short-term surge in demand. They believe that we want to build sustainable growth. They believe that there is a better trickle-down effect of every rupee spent on capex. There is a 3.6 multiplier to that capex. And that's the growth path and the policy path that this government has taken. And hopefully now, in fact today I think the chief economic advisor said that the private sector is also starting to do capex, right? Because now I think broadly people were first saying, okay, let's wait for 2024, let's see what happens, and then we will do. But I guess, that's all broadly now in the bag, right? So I think the private capex will also happen.
So in terms of stock markets, where are we? I mean, are stock prices running ahead of growth? Do you see, do you just simply have to take a longer time frame to be able to justify the prices today? How do you view it?
It's very interesting, this whole debate about India is expensive. Well, I mean, see, look, there is undoubtedly, we are in a bull market. There is no doubt about that. There are always pockets of excesses that may happen here or there. But at an aggregate level, I don't think that the markets are expensive or irrational. And I'll tell you, if you take the top 500 companies, you take the NSE 500, so it's pretty much the representation of 80% of the market cap, 85% of the market cap. You add up the PAT of all the top 500 companies as of March 2020, just before COVID. And if you look at the numbers first half of this year, September, and I just annualize it for simplicity. So you get a March 24 number. So usually the second half in India is better from a profitability perspective.
Right.
Has anybody done the numbers? What has been the CAGR for the top 500 companies for 4 years between March 20 to March 24? It's 38% CAGR in earnings. Now, if you take the total market cap of the top 500 companies and do the same exercise between March 2020 and today, the top 500 company market cap has compounded at 28%. So there's a 10 percentage point CAGR gap between the earnings growth and the market cap growth. And the numbers for the Nifty, what we did a calculation was about 25% CAGR for the Nifty earnings and 27% or 27% CAGR for the Nifty itself over a 4-year period, over whatever this 3.5-year period. So where at an aggregate level are we so expensive? Now obviously we are not cheap, but you have to go back and look that India traded cheap only when there was a big global macroeconomic headwind. Like the global financial crisis, when you start trading you bottom out at 10 or 12 times, or during COVID, or something like that, or during the tech bust. We're not anywhere near there, right? And therefore this fetish that people have to again keep looking at the aggregate valuations of the market and feel very nervous about it. I'm not nervous at all.
Fair enough. So you talked about 38% growth in earnings, right? Now,
and mind you, this 38% growth is taking into account lockdowns, reopening, Russia-Ukraine war, oil prices going up, commodity prices going up, So in 4 years, you've seen a lot of picture up and down. The net result, we've seen a phenomenal improvement in India Inc.'s profitability. Now this includes the PSUs, it includes the private guys, it includes the banks, your top 500 companies, right? So you can't say you're being very selective, X oil and gas, X banks, no, top 500 companies, 38% CAGR in profits is not something that you can scoff at.
No, totally point well taken. My point is that in this earnings composition, of course you have not weighted, you said a simple aggregate of all profits.
Yes.
Now, certain sectors which have a high weight in the index, for example IT, these have contributed significantly to that earnings, right? Because post the biggest growth
up
came
to 22.
there. So
you had a big surge, but last year was a slowdown for the big tech companies, right?
Correct.
They were hardly growing at
the
single
numbers
digits.
have not true, but we are still at elevated levels in terms of where we were in 2020 versus where we are in 2024. Earnings are significantly higher. My question is, are there pockets where you see growth actually contracting from here on? Is there a worry of that, which will sort of say that over the next 2 years, this gap that we have seen between earnings growth and stock prices will get evened out if the earnings growth pace slows down? Is there any risk of that sort that you perceive?
Yeah, see, actually, if you see what happened in 22-23 was that we had actually a contraction in earnings in the broader market. We didn't see it in the Nifty 50 earnings because the banks had the best run of their lives, right? But the non-banks had a big hit on their EBITDA margins, right? Because after the Russia-Ukraine fracas broke out, commodity price went haywire, supply chain, shipping costs, everything. And we did a study. If you take the top 500, there are about 82 financials. You take them out, you take the balance 418 companies. the first 9 months of the fiscal year 22-23 saw a 550 basis point contraction in EBITDA margins. And there was a negative swing of 35% at a PAT level for those 420 companies, non-financial companies. So if you have events like that which slow down your earnings growth or impact, then certainly, and that's why we saw the stock prices correcting in 22, right? So the markets are not irrational. There was negative operating leverage. When commodity prices started to come back down, we are seeing that all those margins that we lost are coming back. So we are seeing now a positive operating leverage, and the stock prices have also reacted to that. But because of the recency bias, we all feel that, oh, market bahut badh gaya hai. All these small and mid caps have run up a lot. Now again, I'm not saying there are always pockets where there could be euphoria, where there could be overvaluation. We have to be careful about it. But when I look at the aggregate picture, the markets are not irrational. There may be certain areas which may be irrational.
Fair enough. So what are your, if you were to count your top 3 bets, what are they?
So again, without going into company specific, but over the last 2 years, especially last 12 to 18 months, we've substantially pivoted our portfolios towards capital goods, infrastructure, power, real estate, defense, all sectors which people term as cyclical, so to speak, right? I think there has been a very clear tilt, because we do believe that over the next few years, these sectors will grow. And let me give you, we did this interesting study, right? We put all these 4 or 5 sectors which you call cyclical. In 2003, in the previous bull market, the weight of, and this includes cement and all of that, right? So the real infra, the cap goods, all of that. Their weight was roughly about 33-34% of the top 800 companies. I'm not talking Nifty now, top 750, 800 companies. Right? So very representative.
Right.
At the peak of 2007-8, which was the go-go years for infra and all of that, it went to 67%. From 67% in the next cycle, which was the destruction cycle of the so-called cyclicals, that went from 67 down to 30. And banks went up from 15 to 40. Right? I think the role reversal is happening again. And that's why people will keep arguing, and slowly, and it's never a one-day process, it's a multi-year process, right? The weights of the banks may keep coming down, and the weights of the so-called cyclicals may keep going up. So I think we've just aligned ourselves, because I believe that, if the context changes, then you have to change. This government is all about infra, capex, and also the world is moving there, right? Because everybody is trying, the global supply chains are changing, everybody is trying to become Atmanirbhar in their own way. America is doing the same thing, right? So why should I be biased about what worked in the last 10 years and stick to it when I think things are going to change?
So within this space, I wanted to also ask you about oil marketing companies, because now it's been like, this is the last set of public sector companies that have really joined the rally. Yesterday, all of them were up 6%. I can't see the prices here now. But again, there is a very strong positive narrative coming around them. Of course, one is the stability in crude prices, refining margins. That is the business story. What's your take? How do you play this?
Well, we are also trying to put our heads around this. Again, to be very fair, is that these were never in our consideration set as things to look at for investing, right? But in markets, you never say no.
Right.
You should always be very objective. You don't have your bias, and you got to look at it as things stand. I don't think I have a definitive answer. Yes, there is a lot of narratives that are going around. I think we will have to convince ourselves that this is something which is more structural. I do know one thing, that investors were relieved when they saw that, and also I think the energy of the petroleum minister said that there is no case for cutting fuel prices ahead of the elections.
Right, right.
Because one of the big hangovers on these companies was that ki election ke pehle kaat denge to kya hoga, right? And I think this government is very clear that they want to strengthen the balance sheets of the PSUs. They're not going to do anything which will hurt the long term. Though I must say that when push comes to shove, governments do take short-term measures which could impact profitability. Right? Like very classical thing that you would see is that they would ban all exports of price-sensitive agricultural commodities ahead of election. They don't want any flare-up of inflation anywhere. So we have to be careful. While in general, they've been very pragmatic. They are very clear that we want to create value in these PSU assets. We don't want to keep tinkering in and out in terms of policy. Some of that is starting to rub off on their valuations. Now, whether what call you take on refining margins, what call you take on marketing margins, that's, I don't think we have at least got our head around it. One fine day when we get our head around it, we'll take a call.
Sure. So within this industrial SPAC, you said, you've aligned your portfolio to ride this cyclical upturn. Are there any pockets that are looking undervalued, and are there pockets that are looking exuberant? For example, I mean, it's chalk and cheese to compare railways today to, several other pockets.
No, I must say that while I must caution that this is a 8-10 year trend. But I also believe that in many of these areas, a lot of the future is already getting discounted very quickly, right? So I think right now the momentum is in the favor of those sectors.
Right.
I think the key thing is that whether when it's a very clear thing, जैसे ऊपर जाता है वैसे ही नीचे आता है, right? So when there are drawdowns, do you have the conviction to stay invested, to really play that long-term hypothesis? Or then are you going to chicken out, and right now everything looks good because the momentum is there for that sector, right? So we are very clear that we are in it for the long haul. Maybe there may be areas or subsectors within there where I can't say they are cheap, because I think a lot of the good news is in the price. But I also understand from previous cycle that I don't want to keep a bias, it's up 100%, it's up 200%, so I must sell.
Because it can also overshoot on the other side.
I mean, when we bought Bajaj Finance in 2010, market cap was 1450 crores. So every doubling, if I would have doubted myself, so it went to 3000 crores sell, then it went to 6 sell, 12 sell. It's 4 lakh crores today.
Yeah.
Right? So you never know. I'm not saying all of them will go there. Right. So, let me kind of caveat that. But what I'm trying to say is that at current valuations, I would be careful. I would assess. And clearly, if I'm buying today, I'm not buying for the next 6 months. I'm not buying for the next 12 months. I'm in it for the long haul. And you are absolutely right. For me to make money from here, I have to be convinced that this is something which will work over a fairly long period of time. And I don't think that there is any deep, there could still be, you could argue there is probably still value in PSU banks because they still trade. And as I said, I don't know, who am I to decide what price to book the market, I don't know what the larger wisdom will give. So there are pockets. Agrochemical is another area which right now, because the cycle is so against them, that the stocks haven't done well. But again, you don't know when these things will bottom out. But I think that's one area which has not done well, like everything else in the market has done well, right? Metals is another contentious
So
area.
does this include specialty chemical companies like Aarti Drugs and all of?
It does to some extent, because there also, but you know, we have to be careful that there the valuation had already spiked up substantially.
Correct.
Right? They were all trading at FMCG kind of valuations,
Yes.
and now there are headwinds there. So you may see not just a price correction there, you may see a time correction
Right.
in the specialty chemical companies as well.
Right.
But yeah, I mean, like you have to start thinking hard where you find very deep value now in the
Is
market.
there any space?
As I said, maybe
Is there a space where you are contrarian?
one space that you know we are thinking, but again, it's not something that we've moved in headlong, is that anything which is low ticket consumption, right, has not done well, right? So now typically people say FMCG companies or whatever, but I would say FMCG plus a lot of anything which is consumed at the bottom of the pyramid, right, small ticket, has not done well. They've struggled, right? Maybe there will come a point where rural consumption might start to pick up. Now, on and off, as this third quarter earnings come, we are looking at the commentary of a lot of companies, and some people say no, it's still very morose. Some people say okay, we are seeing early green shoots of recovery. We'll wait and watch, but it could be interesting, you know. Okay. One area where we took a call there was two-wheelers, which have done quite well.
Fair enough. Okay, there is also this narrative about, you know, large cap versus mid cap, small cap, more premised on the fact that if FII money flows in thick and fast this year, then the natural place for them to hunt will be large caps, which will lift that segment of the market. Do you buy into that narrative? Do you think that is, of course, based on historical valuations, you would see value in large caps, but we are questioning all of that. So I'm asking you this question.
Look, I think eventually if this market has to go up, the large caps will also go up and the mid caps will also go up, right? It really, you have to look at where you want to bet. So if you said the big banks didn't do anything in 23, but I could argue Tata Motors has doubled. It's a nifty stock. It has doubled, right? So I don't want to get to generalize that, okay, large caps are cheaper and mid caps are expensive. I mean, mostly we run multi-cap strategies. We look at opportunities across large, mid and small. I'm equally comfortable buying a large cap if I think that I'll make money there, and I'm equally comfortable buying a small or a mid cap, right? Having said that though, if I were to keep my thinking cap of Naye Race Ka Naya Ghoda, right?
Right.
By and large, the previous bull market belonged to the bigger companies.
Correct.
If I were to stick my neck out and say that if you take a slightly longer term 7-8 year horizon, I think the leaders of this bull market will be the small and mid caps in general. But again, I would caveat even to all of the listeners that it's a space which is very volatile. You know, you just can't you know, go gunslinging. You have to be very careful.
Right.
But and the reason again is that, you know, the representation of the sectors which are doing well are more in the below 200, the top 100 companies, right? And for obvious reasons, the stuff that did well and compounded well, their market caps went up, so they all found their way into the Nifty, right? I'll give you another example. Real estate, the weight of real estate was about 6.8% in 2007.
Right.
In the top 700 top 750 companies. At the low of the cycle in 2019, it was 0.6.
Correct. Got decimated.
Now if you see small developers, you know, small companies are delivering fantastic numbers, but they are underrepresented in the sector, right? And that's where the mismatch is going to be. That many of these sectors, So I could again, like, when people use one argument कि अगर इंडिया ग्रो होगा तो क्या बैंक्स नहीं ग्रो होंगे, तो मैं बोलता हूँ कि अगर इंडिया ग्रो हो गया तो क्या लोग घर नहीं खरीदेंगे.
Correct.
Right? So I think it's something like that.
So you are bullish on real estate, are you?
I am very bullish on real estate.
Had a fantastic run last year. Nobody expected it to be up. The index itself was up 60%.
You see, what has happened, Mahalakshmi, is people forget that in many of these sectors which went through a very deep cyclical downturn, more than demand, what got destroyed is the supply.
Correct.
The number of developers that went out of the market.
So the industry consolidation.
Industry consolidated.
Helps consolidate
and now
profits.
as demand comes up, these few guys who survive are going to make shitloads of money. You look at the EPC or the so-called infra players.
Yeah.
Okay, in the previous cycle, you had JP, you had Gammon, you had IVRCL, you had HCC. I mean, you had so many of these, Simplex.
Yes.
Where are these guys? Half of them have got Punj Lloyd. Where are they? Now, only L&T is surviving. Maybe an NCC survived. Maybe a couple of these other guys have survived. But the number of players have gone down to half.
Correct.
And the spending on capex has gone up 4x. So obviously, these guys are going to do far better. The survivors are going to do far better.
Okay. Any segment of the market that is setting itself up for disappointment apart from financials?
I think I have been saying this that, rather than categorizing it as PSUs or private or whatever, I think low floating stock companies, one has to be very careful, right? This is a very ripe environment where you may not have the best price discovery if the float is very low. Secondly, I think there is, at least for the last few months, there's been an absolute euphoria in the IPO market.
Yeah.
So you got to be very careful about what is happening there. 100 times, 150 times.
Yeah.
Well, at a national level, I'm happy for the for India's economy that companies who need risk capital are able to get money. But I think not all of them merit the kind of valuations or
many
immediate.
of them are also exits, not even risk capital. So
just completely right. So I think one has to be careful in those areas.
Fair enough. So by end of this year, Hiren, are we going to be up 40-50%?
Oh.
Or are we going to be because everybody says 12 to 15%, but the reality is that markets never go 12 to 15%. Over long periods, they compound at a certain rate. But year on year, it's always hugely up or hugely down or, nowhere.
I'm still reasonably bullish. I don't want to give a number. I can, again, if history is some guide, and history may not necessarily repeat itself. So if you see a lot of interviews that came early on in January, because every time a new year starts, everybody starts thinking about okay, kya hoga next year, and like people saw okay, if mid caps are up 40% and small caps are up 50% and the NIFT and the large caps were up some 20%, then this year it could be a moderate year, right? It was almost becoming fashionable to say okay, don't expect, and that's good because I think we should have moderate expectations of returns. But I would ask people to do a little bit of research that in the 2002 to 2008 bull market, you take a calendar wise return of large cap, mid cap and small cap. You will be bewildered every single year from 2003 up until 2007. You had massively healthy double digit returns year on year on year, right? Because the Sensex went from 3,000 to 21,000. Now, I am not saying, I'm not saying something like this will happen, but neither am I saying that this can't happen. Right? We are bullish. We think markets, generally the long-term trend is very, very solid. Now, whether they go up 10% or they go up 30%, we'll embrace it with both hands.
Sure. So Hiren, one last question. You were very close to Rakesh Jhunjhunwala.
Yeah.
And he always used to say, the mother of all bull runs is yet to come. It's ahead of us and all that. If he were alive today, what do you think he will say about, what do you think will he have to say about markets today? How would he navigate it?
I don't think he would say anything different.
So mother of all bull runs is still ahead of us?
Yeah.
Or we are in it?
We are in it.
Apna time aa gaya hai.
Apna time aa gaya hai, right? He said that actually.
Yeah, he said that, yes.
He said that apna time aa gaya hai.
Correct.
But I think he would have also cautioned if there was unbridled, runaway that, he would have said that be careful of what you buy now, but certainly don't sell. Right? Because I think the best way to play the bull market is to stay committed to it. You can't get on and off the horse. You have to stay on the horse. Your horse may not be galloping. You may have be trotting. It's fine. But you're trotting in the right direction. And once in a while you'll gallop in the right direction. But don't get off the horse. And I think that's the message that he would have given. That's the message he gave us in the 2002 bull market when he was so convinced.
Right.
He said, "Chodne ka nahi."
Right. Sure. On that note, thank you so much, Hiren. Such a pleasure talking to you.
Thank you. Thanks for having me.